Hello, I'm Greg Bonnell. Welcome to TD Active Trader Live, brought to you by TD Direct Investing. This is your educational one-stop shop for in-depth market analysis, investment insights to help boost your trading potential. Coming up, we got U.S. markets pushing higher. That's after NVIDIA's results, boosting confidence in the AI trade again. In just a few minutes' time, we're going to speak with Washington Crossing Advisors Chad Morganlander about the tech sector, the AI funding boom. We're going to hear what's driving both the excitement and the caution. Plus, with credit spreads near record lows, he's going to share where the market could be vulnerable and the risks to watch. And my colleague here in Amin is in studio with us today, special Thursday. So on today's Technical Take, he's going to break down Lockheed Martin's chart and highlight 2 potential ways to trade it. That's all ahead. Don't forget to like and subscribe. You're watching TD Active Trader Live. We are half an hour into the trading day. Let's check on the S&P 500. Some pretty solid green on the screen. That nice pop you can see out of the open. NVIDIA was the big event of the week after the close yesterday. The street is pleased. We also got that delayed U.S. jobs report. Unemployment rate's still low, added more jobs than expected. Let's jump into the heat map. I think you're going to see a lot of green names that are going to be tech-driven. NVIDIA, we'll get to them in a moment. Apple, Google, Microsoft, Oracle, Broadcom, IBM. I could go on. You get the picture. Although the financials are rallying as well, and some of the healthcare names and some of the consumer stocks, even though Amazon's in that bucket, still feels a little techy. Let's get into NVIDIA. We were all holding our breath around 4:20 Eastern time yesterday when we got that result. Revenue jumping 62% to over $57 billion year over year, issuing stronger than expected fourth quarter sales guidance. So we all feel pretty good again. We're going to talk with Chad Morganlander in a moment's time about what we need to be aware of as well. Let's check in on Walmart. Bit of a different kind of story here. Also posting its third quarter earnings and revenue that beat expectations, raising its full year forecast. Retailers saying it drew more shoppers across all incomes coming into Walmart. But remember, when we debated Walmart the other day, one of the points that was brought up on the bear side was the SNAP program in the States, which of course was affected by the government shutdown. They saw a bit of a pullback there. But right now, that doesn't seem to be affecting the stock at all. You get a nice pop on Walmart out of the open. And that's your market update. All right, joining us now, we have Chad Morganlander from Washington Crossing Advisors. My co-host here in Amin is with us here in studio. Chad's joining us from New Jersey. Just a reminder before we dig in to our viewers that the views and forecasts expressed are solely those of Chad and his team at Washington Crossing Advisors and based on their research. Chad, you and I were chatting yesterday afternoon before NVIDIA came out. You have some concerns about the AI trade. NVIDIA seems to have delivered. The market seems to like it. Give me your read on the situation.
So it was expected that it would be a strong beat on the top and bottom line, and that's perfectly fine. NVIDIA is a very heavy weighting within the S&P 500 of roughly about 8%. So as NVIDIA goes, so too does the S&P 500 in the short run. And that's why you're seeing this early rally. My major concerns is that not that artificial intelligence isn't real and it will increase productivity and whatnot, but the reality is that there is starting to be a nonsensical overbuild and as well venture capital money is starting to run towards any silly idea that comes out that has the 2 letters AI in it. They're willing to give $1 billion to $2 billion. So we're in more of a euphoric, overheated market when it comes to this with this cycle at this point. That again doesn't mean that we're bearish on artificial intelligence over the next 10 to 20 years, but buyer beware at this inflection point.
We started talking about the money that's moving into AI, and as you said, any ideas sort of getting the funding right now, if you can put the words AI together in the pitch. Start thinking about private credit and the role it might be playing. Is that a concern for us? Because we've had some concerns about the quality of private credit lately. So
private credit, for the time being, is focused more on businesses around the general economy, and there's over $2 trillion of that floating around, and that is really more high yield, riskier creditors. My concern is that some of the financing that is happening currently when it comes to data centers for the weaker hands may eventually have to be unwound or reset in regard to the reorganization of those ventures. But it's not yet a gigantic portion of private credit. But overall, private credit, there is some weakness there, and we would be very concerned about that side of the system.
All right, Chad, let's actually keep on that theme of credit markets as well, because historically we're at tight levels. If you look at the 2024 to 2025 right now, we've been trading in that 65 to 80 basis points. By long-term averages, that should have been about 130 to 150 basis points. So sentiment by that measure is extremely complacent. So is there any warning signs that you're looking for a potential credit event?
Yeah, well, you can go back 35 years and you can look at the high yield spread to Treasury. And what you'll see is that we're now, for the third time, trading at such a tight range. This usually is a watermark of a more of a euphoric environment, one where investors are mispricing risk, not only fixed income investors, but also equity investors. And what happens here is the feedback loop on that is that when credit spreads are ultra tight like this, then you get high multiple companies or high beta companies that are have lower quality balance sheets that actually the stock prices act and behave in more of a euphoric manner. So any type of normalization of that credit spread really could have deleterious effects on not only the markets, but clients' personal wealth. So at this point, we're just being more mindful of this, and we're trying to express that viewpoint that to not only focus on the stock market, but focus on that credit spread in order to, really, it's really your carbon monoxide detector in your house. You want to, when it starts beeping, you should be aware of it.
Okay, so now that we've got the NVIDIA earnings out and we're going to, AI bubble chatters kind of cool down a bit, just in some of my research and some of the analysts that we're starting to hear more about a potential like black swan event, what it could be. And I'm going to turn my attention to the Far East, and that's what's unfolding in Japan. They've seen the 20-year yields kind of hit levels they haven't seen since 1999, sitting about 2.75%. Now, that may not seem like a big number to us over here, but they've enjoyed about 3 decades where it was like zero to sub-zero at certain points. But on top of that, you also think about their debt to GDP. They're at 237%. That is the highest, I think, in the world. And maybe you'll correct me if I'm wrong on that part. So the story unfolding here is if they're going to have a high debt to service, obligation, they also have about 3.2 trillion in assets. They're the largest holder of U.S. treasuries in the world, 1.1 trillion. If they need to have liquidity, what does this mean for the credit markets, and could we possibly see a yen unwind 2.0 trade happening?
Yeah, that's a good question, and you're bringing up some valid points. Well, you had an election in Japan, and what it looks like, the Japanese want to have a weaker yen policy. And on the back of that, if you look at the chart on the yen, it is trading at a 5-year level that's indicative of a weaker yen. And so to lockstep are the yields. They're going higher. We, at this point, are not terribly concerned about it in the short run. Now, this could be one of these Liz Truss moments when, because of a generous fiscal policy and a weaker yen policy, you get an unwind of the long end of the curve, meaning they lose control of that. And to your point, their fiscal balance sheet is really not in the best shape, their balance sheet. So you're not yet there, but if you started to see 100 to 150 basis point march higher across the curve, I would then generally get worried as you start seeing that march. So keep one eye on this, but I wouldn't get out yet.
Yeah, well, I feel like we have one eye on a lot of issues, Chad.
Right.
We started the conversation. I'm looking at my heat map right now. I've got all these tech names rattling. We started the conversation with the concerns you have around tech. So in this current market environment, what is not being appreciated? What's being ignored? What's standing out to you that isn't all this green on my screen from tech names?
So, Greg, it's high quality, consistent blue chip companies in the United States that are unrelated to the artificial intelligence build out. A lot of them are selling at decade lows regarding valuations. So it could be the U.S. general economy because it's decelerated a bit. Some of those multiples have contracted in a pretty radical way. So I would look no further as a company like a Procter & Gamble on the consumer staple side. The consumer staples now have yields that are multi-decade highs, and they're still consistently growing, durable, with balance sheets that are quite sturdy.
Okay. And Chad, let's talk about the other side of the risk on assets. We saw the sell-off, and we're going to get back to high quality, but crypto, that's a space that's historically 3 to 5 times more volatile than the S&P 500, and we've seen a bit of a shakeout that's taken place. Bitcoin has broken through a key level of 100,000. It broke through a key support at the 93,000 level as well. So it remains a highly debated asset class. So how do you view the trends within the crypto space?
So there's some utility to some of these coins, and then there are many coins that are just nonsensical. So it's more or less what we're seeing not only within the crypto world, but also in the stock market here in the United States and across the globe, is that it's becoming more like Gambler Nation. And buyer beware, because when you're buying something, you want to have a claim on the future cash flows of that asset. Hoping that the value will be a stable value for not only 3 years from now, but for 30 years. And many of these crypto coins are experiments. I know that we're embarking on stable coins. Buyer beware there, because like the money market funds, you may start to see, as these things mature, breaking a buck that becomes more consistent than one would hope. So we would be scaling back. Just make sure that you size the volatility correctly in your portfolio, because if you don't, you may wake up one day and be really, really sorry that you didn't heed that warning.
All right, so that's the digital currencies, maybe, I don't know, the Fed, traditional money, the old school and the new school. Right now, the market seems to have a bit of a coin flip as to what the Fed's going to do in December. I think you're still looking for a cut. Explain the rationale there.
So the real economy is slowing down. When you listen to the earnings calls, and I have been listening to dozens of them over the last week or two, you come to the realization that there is a deceleration of consumption patterns, a deceleration of economic activity. It may very well be temporal, but overall, I don't believe that the Federal Reserve is going to sit on their hands. I think they're going to lower rates by 1/4 of a percentage point by year end, in order to make sure that they guarantee that they're positioning correctly. Also, what was quite revealing was the fact that they're not lowering their balance sheet anymore. They're going to hold it steady. So there is more of a dovish tone to the Federal Reserve, and we believe that dovish tone will continue into 2026.
All right, Chad, and so now we talked about the Fed, but I also wanted to harp on one of the theses that you put out. I think it was in the October newsletter you had, where you talked about the divergence between the high quality and low quality names out there, or between the momentum ones, let's call it that. So could you just walk me through kind of what's the core premise behind this framework, and why do you feel that the pendulum is poised to swing back?
So what we've noticed is that there are times in cycles where you have steady Eddie companies that are growing, profitable in a consistent manner, and don't have a lot of debt. And they are the higher quality names, the lower volatility also in them. And then you have those are high quality. Then you have low quality companies that are unprofitable, may have a lot of debt, lower return on invested capital and whatnot. And what you've seen over the last 4 cycles is that lower quality companies could rip higher, outperform drastically the high quality. And at the end of each cycle, when you have high quality come back into play, which we've seen happen roughly about every 20 months or so, high quality stocks go higher, and lower quality companies tend to go lower. And so what I am trying to express in that research report with my colleague Kevin Karan is that the tortoise and the hare, the tortoise wins the race over a longer period of time with substantially less vol. So you have to be mindful about volatility, as well as that these cycles and the pendulum goes one way to an extreme and then can circle back the other way. And we believe right now is the right time to be in higher quality, more durable, consistent companies in order to not only preserve capital, but to grow it over a longer period of time.
With that in mind, Chad, what does the strategy become for 2026 then? What do these markets look like? They've been rallying off the back of the strength in the AI trade, all the excitement around tech. If we're thinking about your strategy, what could the S&P 500 do for us next year?
So you can see the S&P 500 flat to down and one must recognize that 50% of the S&P 500 is only 20 names. So there is the other 480 or 470 names that represent the overall market. And you could see that the others, the have-nots or the higher quality names within that 480 do quite well and go higher to higher highs. But we think that overall, many of the more concentrated bets within the S&P 500 are quite risky. Like take, for example, a Palantir trading at 100 times revenues. That means that the growth rate that is embedded into the perpetuity rate forever and ever has to grow at a rate higher than GDP. That's a nonsensical mathematics. So that means to us, the math isn't mathing. So you have to just be mindful about these market leaders, because if there's any kind of hiccup, deceleration, or whatnot, they will be the ones where the multiples will contract the fastest in the most radical way.
Chad, it's always great catching up with you. It's great to get your thoughts, and I hope we do it again very soon.
Thank you. Thank you for having me on.
That was Chad Morganlander, Senior Portfolio Manager with Washington Crossing Advisors. And just a reminder to our viewers that the securities and strategies discussed on our show are for educational purposes only and should not be considered investment advice or buy, sell, or hold recommendations here. And Chad, of course, had a lot of interesting things to say. Yeah. I love it on a day that, NVIDIA comes out, the entire market is watching NVIDIA. It delivers what the market wants. The market is pleased. Tech is rallying, but he's not jumping on any bandwagon. He's saying, well, I've had concerns about this tech-driven rally for a while, and I still have these concerns, despite the fact you look at the screen today, and there's a lot of green, and it's a lot of tech that's green. Yeah,
we're going to see whether it's short-lived euphoria or it's actually going to sustain itself. I think the biggest thing coming into this, what did they dub this as? The NVIDIA's earning was a seminal earnings, but it also was a broader question about the AI bubble that had been, brewing for the last couple of weeks, and maybe that put it to bed to some degree, or it's at least pushed it out till the next earnings cycle that we saw. But the other thing that he mentioned, which was key, was the valuation at the end, which is the math is not mathing when you think about some of these names, especially the tertiary periphery plays, the neo clouds and other parts that are part of the AI play. Where you think of these numbers, then they're eye-watering. They could just never sustain themselves over the long period of time. So certainly one to look at. I don't think the risk is completely eliminated. I think this is like a blip. Yeah, this is NVIDIA's story, a very core part of that AI narrative and the overall market. But you've still got risks across the board. But maybe it's an opportunity where you're also seeing high-quality names as he's what he thinks is the cycle is what we're going into now, where those are going to be bid up there.
Yeah, it sounds like sharpen your pencil times, right? When he talks about an S&P 500, that could be either flat or to the downside next year, but the concentration of 20, there's other names you can look at. The other 480, you can look at those, and maybe there will be opportunities in those.
Yeah, I looked at a stat yesterday, and they said, look, if you take out the Mag 7s out of the S&P 500 and you look at the performance, it's not that bad. You're talking about 1 to 1.5% difference, stripping out the Mag 7s and compared to S&P. So there is a bit of participation coming in as well from the broader names, and that really speaks to probably that rotation piece on some of the sectors that are being bid up, like the healthcare and some of the industrials that had a bit of a doldrum years coming into this year.
Lots there for our viewers to chew on, and lots more show to come. But if you at home have a question for our guest or our team, here's how you can get in touch with us. Just email td.activetraderlive@td.com. And for more information about the Active Trader platform, scan that QR code on the bottom right-hand side of your screen. It's going to take you to our TD Active Trader Live website, where you can try out the platform risk-free. All you do is open a practice account, you click on that Try TD Active Trader button. Then when you're ready to switch to a live account, simply export the workspace, start trading for real. On the markets, luckily we have Hiran right there for that. And you're taking a closer look. What a day to look at the NASDAQ 100.
I know. Yeah, we're going to be looking at the triple Qs, of course. This is the ETF, one of the most liquid ETF that tracks the NASDAQ. But coming into this, there was a lot of volatility that was baked into it. We saw the Qs actually peel back about, shed about 5% this month coming in. And that was all around the AI narrative, right, Greg? And so the big thing that I wanted to look at was obviously NVIDIA's earnings. And one of the things that they, peeling back Jensen's remark yesterday was, I think it was the first time any executive in NVIDIA, and especially him, talked about the AI bubble. They addressed it. And, I think he quoted as saying, from our vantage point, we see something very different. And of course, the numbers would support that, of course. They breached $50 billion for the first time on their data center revenue that they've never done. And their annual revenue run rate now stands at about $204 billion. Now, this is a stark comparison. If you think about that 4 years ago or 5 years ago, they were just doing $4 billion annual.
They're selling chips for video game consoles, right?
That's all they were doing. That was their revenue maker, and it's still that's kind of stagnated there. So that's a big part of the sort of thesis coming into this. So let's look at how the charts have kind of unfolded in the tech space as well. So one thing I just wanted to point out first, we saw the Qs coming in from this the September or April lows into the summer really formed this big bullish channel that we saw, but here's where the crack started to form when it broke out of that channel at the start of this month. We saw it break out of it. And usually when you want to see a breakout, and if it's going to be a counter or bearish trend, we want to see confirmation happen. We did see consecutive closes below that, which did actually push it into, we've got these clouds in here. These are called the Ichimoku clouds, and they usually show us areas of support and resistance when we're looking at it, whether it's bearish or bullish moves. It did actually breach the clouds, which it hasn't done in a while. It actually hasn't gone through the clouds on the bull side for a while. But today, I don't know, maybe we can try and zoom in on this a bit, Greg, but we did see a big gap up move happen, and that's why you can't really see the candle, but it's sitting right at my resistance level of 610. And this is a key level. It's taken this level back. We want to see whether it can hold that level into tomorrow's close as well. If it can, maybe they can resume that rally, get back into that bullish channel. So that's one to look at. But we also see, I'm going to my momentum indicators to look for confirmation, and I look at the stochastics, and I can see they've actually touched the oversold level. This is the first time, and if I look back in this charts, you don't see that happen since the April Liberation Day time. So it just hit those levels, and this is seen as a key sort of reversal key level. So maybe this is the leg up that they need going into maybe what's promising to be a Santa Claus rally into the year end here.
All right, great. Looking at the triple Qs, I think a lot of people are looking at the NASDAQ 100 right now. It's up about 2%. You also have Lockheed Martin in the sights for us. What's the
let's talk about Lockheed. I'm a bit of an aviation geek, Greg, and what's happening right now, if you out in the Middle East, is they've got the Dubai Air Show happening. It's like the big, one of the largest aviation events, of course. I mean, most of it is commercial, but they do a lot of, defense, players are showing up there as well, and Lockheed Martin is a big part of that. So one of their, just to introduce Lockheed Martin to our viewers, they're a global security and aerospace company. They're the world's largest defense contractor, and it's dominated the Western market for its high-end fighter aircraft. And this one's made the news recently. It's the F-35 jet, of course. Now, it's a joint strike fighter program that was launched back in 2001. They've kind of had a stronghold on that. That's really have them legged up. But the news coming into this week, there's a couple of things. We knew from the Canadian side, defense spending was increased as part of the budget, and they had committed to I think it was 88 orders that they wanted of the F-35. Now, what's actually happened recently, I just read a headline yesterday that they were probably looking to peel back on that.
They might be diversifying.
They're diversifying, and I think they're touting Saab's Griffin fighter from Sweden as well. It's potentially seeing if they cancel that order. But Saudi Arabia was also visiting Washington, D.C., and they're trying to strike up a deal as well and order some of those jets. So that's kind of what the backdrop is for Lockheed Martin. But going into the charts, it's been a very volatile chart. I just wanted to look back at the start of 2025. It's kind of peeled back quite significantly from its highs. I mean, I can go, it's pretty much like literally off the charts. They're sitting at close to about 600. They've had a significant steep drop, but then they've chopped around quite a bit between this 445 to 490 range. Now, what that brings us into right now is we see, again, a bullish channel formation happen over here. We did see the break happen in like kind of late October. This was just around the earnings period here. It was lackluster. We didn't see a big momentum here. But we do see this big bearish counter trend that's formed now. This is what is going to be acting as the immediate sort of resistance. So it needs to take back this level, get back above it. And the next level that it's probably going to breach on the top side is the 490 needs to capture here. Now, when you look at kind of the momentum, RSI is still in just below 50, so it's still in bearish territory. You usually want RSI to cross above 50 and start inching towards the 70 mark to be back on the trot. So that's one to keep an eye on. But on the charts, you also do have the 460 level as well, which is kind of the support. So if it maintains and keeps, respecting this counter trend that we have, it could, could retest the 460 and bounce off of that before it resumes again. So this is how the price action's unfolding here.
We got the chart. We're looking at the price action of Lockheed Martin. You've done all that nice work. I think we should probably get into the bear and bull arguments here.
Oh, yeah.
And how to trade those sides.
Yeah, I'll take both avatars and play that on there. But we'll skip ahead, and maybe we'll just go right to the trades over here.
Right to the trades, because I don't have a bell. I don't have a bell, and I don't want you to argue with yourself.
Yeah, or with you, Greg. So let's start with the bullish story over here. So what I've got is, and I'm going to try and see if I can do the big reveal here or hide it. See some of my magician tricks, but I'm giving it away. So if you're considering a bullish move on Lockheed Martin, especially with the news and some of the deals that are being struck, and you might think like there's certain levels that could recapture, we eyed the 490 level as a potential area of resistance where it could go up to. One potential trade you could look at is doing a bull call spread. Now, what this trade essentially is, it is a directional trade, so we're looking to participate in the upside move. We're looking to buy a call. In this case, I'm going out to the March cycle, so that's pretty far out. We're looking at 120 days. The reason we want to go further out in the option cycle is because we want to mitigate the effects of time decay on this trade, which kind of hurts us if we go on a short duration. So we're looking at the 455, which is just kind of, it's a little slightly in the money because that's a key level of support we wanted to try and look at capturing. And then on the top side, I've gone out as far as 505, which is really marking another level if we can break through the 480. So why we want to sell, Greg, is because we want to reduce our costs. Anytime you're dealing with a stock like Lockheed Martin, which is trading in the 500 level, the options are going to be pricey. So doing a single leg might not be, the capital outlay is going to be pretty expensive. So by selling it, we reduce it. So in this case, we're going 50 points wide. What this trade is costing us, you can see I've just got my break even mapped out here, 476. So that means literally it's about like $21 approximately is what this trade is costing us. And now we got to talk about the risks and the profits.
Exactly, the big reveal.
All right, there we go. So what is the upside on this trade? Well, you want the stock to move. If it can move and get to our price of 505, that's the best case scenario. That's when we're going to get max profit. And that's simply taking this $50 wide spread that we have, subtracting what we're paying for this trade, which is 21 and change, and that results in $2,900 or $29 profit on the trade, on a single contract. And if the other side happens, of course, you can see I've marked up some zones. So the break even is the zone between the profit and loss area, right? So if we don't get a big move, first of all, if it just stays below our break even point, we're going to lose on the trade. We might not lose everything. The worst case scenario unfolds if Lockheed actually, as we get into our expiry, stays below the 455 level that we have. If that happens with these sort of trades where you're doing a net debit trade, you're putting money into it, you're going to lose what you put in. In this case, it's $21 or $2,100 is what we stand to lose.
All right, nice breakdown on the risk and reward potential for a bull call spread. What if you're a bear? All
right, let's play the bear trade. All right, so flipping into the bear trade over here, again, we've kind of looked at the technical levels, and the 490 has been a key level which it hasn't been able to capture. If I go back here, Greg, you can see it's like kissed the 490 and then just rejected off of it like a few times here. So that still seems to be a stronghold there. Now, if you wanted to potentially look at generating some income based on this level and you think that, hey, maybe it'll reject off that level, one bearish trade you could do is a bear call spread. So in here, we're actually flipping the script from what we just did. So in this case, we're going further out of the money. So we're going out to the 490 price. We're looking to sell there, that call. And then we want to cap our risk, because anytime you sell a call, you expose yourself to an unlimited amount of risk. So by buying a further out call, targeting the 510, we've now capped our risk over here on the trade. Now, because this is a credit spread trade, you're collecting income. In this case, I think based on today's upsized move, it's about $4 is what we're collecting, but as of writing when I created this last night, it was $3.50 is the credit we were taking. So that's what we take in initially on a single contract, so that's $350 with the hopes that we don't want Lockheed to move meaningfully beyond the 490 level. And that's the key over here. So here's what we're starting to look at. So we want it to essentially expire out of the money, and that happens if it stays at 490 or lower by the time we get to our expiry. And you'll notice in our expiry, we're coming in a lot shorter duration, going out to the final contracts for this year in December, which is the 26th of December there. If that happens, we stand to make $350, is essentially what we collected right now. But if it doesn't happen, and the stock has a run up into the year end and goes beyond the 510, then we will realize the max loss scenario in this case. And again, it's simple as saying, what's the spread? In this case, it's $20 spread, minus what we collected as a credit, $3.50. And that would mean we're losing $16.50, or in other words, $1,650 on a single contract there.
All right, interesting potential strategies there. A reminder to our audience, of course, that options trading carries high risk and may not suit all investors. Significant losses are possible, so it's important to assess your own risk tolerance. Make sure you do your own due diligence before engaging in trading. Well, of course, we always got to bring an end to a show, as enjoyable as they are. Investors should perform their own due diligence before engaging in trading. Now, apparently you're not with us on Tuesday.
No, I got called up by the in-laws. We got Thanksgiving in the U.S. So
U.S. Thanksgiving.
My wife's an American, so we're going to be there. But I'll be rooting on the boys. They'll be filling in.
Mr. Rogers will be on the seat.
Marvell Technologies. We're still going to continue on the AI theme. It's another big player in that space as well. So I'm sure the boys will do it justice and put that to debate next Tuesday.
That'll be Jason and Brian next Tuesday at 10 a.m. Eastern Time, debating Marvell Technology, then giving you possible option strategies here in the platform. And if you want to see Brian before that, noon Eastern Time today on TD Active Trader Live, he'll be with us taking you through 3 platforms: the Active Trader platform, Advanced Dashboard, and Web Broker. A lot more to come today. Thanks for watching.